Have you noticed something strange? The S&P 500 is hitting all-time highs. The news anchors are celebrating the resilient U.S. economy. But quietly, through the back door, the smartest money in the room is leaving the building. Warren Buffett is sitting on a record pile of cash, over $300 billion. Jeff Bezos, Mark Zuckerberg, and the Walton family have sold billions in their own stock this year. They aren't buying the hype, they are selling into it. If the economy is so strong, why are the insiders cashing out? In our last video, we talked about the 2026 reset. Today, we are looking at the smoking gun, the specific data points that suggest the soft landing is actually a trap, and exactly how you need to position your portfolio before the music stops. Let's look at the data. Wall Street runs on greed, but math doesn't lie. Look at the Buffett Indicator, the ratio of the total U.S. stock market valuation to the GDP. Historically, when this line crosses 100%, stocks are considered fairly valued. Today, we are deep in the danger zone, significantly higher than the peaks we saw before the dot-com bubble burst and the 2008 financial crisis. This means the market is priced for perfection in an imperfect world. Investors are paying premium prices for future earnings that simply might not exist if the economy slows down. The disconnect between stock prices and economic reality has never been wider, and history tells us this gap always closes violently. The media keeps telling you the U.S. consumer is strong, but look at what Main Street is actually doing, not what they are saying. Pandemic savings are gone. Excess liquidity has evaporated. We're seeing credit card delinquency rates spike to levels not seen since the Great Recession. Americans are no longer borrowing to buy luxury cars or vacations. They are borrowing just to put food on the table. This is the silent recession. While the GDP numbers look inflated due to government spending, the average American household is drowning. When the consumer stops spending, which makes up 70% of the U.S. economy, corporate earnings collapse. And when earnings collapse, that overpriced stock market we just talked about has nowhere to go but down. But the biggest red flag comes from the bond market. It's called the inverted yield curve. Put simply, this happens when short-term government bonds pay more interest than long-term ones. It's a sign that investors are terrified of the near future. This indicator has successfully predicted every single recession in the last 50 years. It currently has a perfect track record. The curve has been inverted for the longest stretch in history. The soft landing narrative, that the Fed can kill inflation without causing a recession, is a fairy tale. The bond market is screaming that a hard landing is coming, likely hitting full force by 2026. So, the insiders are selling, the consumer is broke, and the bond market is flashing red. What do? Panic? No. You prepare. Step 1. Liquidity is king. Do what Buffett is doing. Build a war chest. High-yield savings accounts or short-term T-bills are currently paying you around 4 to 5% to essentially wait. This is your dry powder. When the market corrects 30, 40, or 50%, you need cash to buy quality assets on sale. Step 2. Defensive rotation. Review your portfolio. If you are heavy in speculative tech stocks or companies that don't make a profit, understand the risk. In a downturn, capital rotates into consumer staples, companies that sell things people need, not just want. Think healthcare, utilities, and essential goods. Step 3. The psychology of the crash. The hardest part isn't the math, it's the mindset. When the headlines are terrifying and everyone is selling, that is your signal to enter. The wealth transfer of 2026 won't go to the fearful. It will go to the prepared. Before we wrap up, you need to understand the single biggest risk factor sitting in your portfolio right now. It's called market concentration. If you look at the S&P 500, it looks healthy, but that is an illusion. The entire market rally of 2024 and 2025 has been driven by just a handful of massive tech and AI companies. We call them the Magnificent Seven. If you strip away these few companies, the rest of the U.S. stock market has actually been flat or negative. This is exactly what happened in 1999. Investors chased the hype, believing that this time is different because of the internet. Today they say this time is different because of AI. But valuations matter. When just 7 companies make up nearly 30% of the entire index, if just one of them stumbles, the whole house of cards comes down. The smart money knows that trees don't grow to the sky. They are rotating out of these overvalued tech giants, while retail investors are still buying the top due to FOMO. Furthermore, we are currently living in what economists call the lag effect. This is the delay between when the Federal Reserve raises interest rates and when those rates actually break the economy. History tells us this lag is typically 18 to 24 months. We are right in that window now. The aggressive rate hikes of 2023 are just starting to hit the balance sheets of corporations and households today. Think of it like a car braking on an icy road. The Fed slammed the brakes a year ago, but the car, the economy, is still sliding forward due to momentum. But eventually, friction takes over and the car stops. Usually, it stops abruptly. We are seeing early signs of this with layoffs in the tech sector and a freeze in hiring. The unemployment rate is the last thing to break, not the first. By the time you see mass unemployment on the news, the recession is already halfway over. You cannot wait for that signal. This brings us to the harsh reality of Wall Street. It is a zero-sum game. For every seller at the top, there must be a buyer. Who do you think is buying the billions of dollars in stock that Warren Buffett and Zuckerberg are selling? It's the retail investor. It's the pension funds. It's the average person who buys because they are afraid of missing out. In the finance world, we call this being the bag holder. You are left holding the heavy losses when the institutions have already cashed out. The Great Reset of 2026 isn't about money disappearing. Money doesn't disappear. It just changes hands. It moves from the unprepared many to the prepared few. The strategy we discussed today isn't about fear. It is about ensuring you are on the receiving end of that transfer. The elite are quietly preparing for the storm. Now, you are too. The only question left is, what is on your crisis shopping list? If the S&P 500 drops 40% tomorrow, which company are you buying first? Let me know in the comments below. If you want to understand specifically how real estate will be affected in this reset, make sure you're subscribed because that is our next deep dive. Thanks for watching, and I'll see you on the other side.